Good day to you, and welcome to my discussion, my continuing discussion, yes, on leases, and this is part 6. I know you already know the drill, but please read pages 882 and 883 and make sure you've done the Learn Smart covering this part of the chapter before you proceed on with this video. It will mean ever so much more to you. In this section of our continuation of leases, I would like to talk about unguaranteed residual values. That means that there is a residual value written into the lease, but the lessee is not responsible for the amount of that residual value. They return the equipment and they can walk away from lease at the end of it. What happens is this results in the lessee using an amortization schedule that does not have a balance showing at the end because they are not on the hook, so to speak, for anything at the end. But the lessor does have a balance showing at the end of the lease. Because of this, the lessee and the lessor do not have symmetry in the entries for recording the lease. Up to this point, we've used the same amortization schedule, had the same receivables and payables, but at this point, that tie is going to go away. Let's get started. So, I've changed our example, our continuing example, to deal with this scenario. We still have a $15,000 piece of equipment, $10,000 or 10,000 per 10,000, 10% interest rate, and 3-year lease payments due at the beginning. And there is a $1,000 residual, but it is not guaranteed. The payment calculation should look pretty familiar to you by now. The amount of the equipment is $15,000. We back out the present value of the unguaranteed residual value at the end of the 3-year lease, and we come up with an amount that is to be recovered through payments. The difference is this time that present value of the $1,000 is treated as though the lessee did not purchase that part of the equipment. They purchased not $15,000 worth of equipment, but $14,249 worth. You still divide it by a present value annuity due interest factor to solve for the payment, or use your calculators using the $14,000, and you still come up with the amount of payment being $5,209. So it's the same for bargain purchase options, guaranteed residual values, and unguaranteed residual values as far as payment calculations go. What I'd like to do now is to prepare amortization schedules. We're going to have an amortization schedule for the lessee that ends in 0, and it's going to start with $14,249, recognizing that is all of the equipment that they purchased. And we're going to have an amortization schedule for the lessee that starts with $15,000, and there is going to be $1,000 left on the bottom of their amortization schedule, even though the lease is not guaranteed. So I would like you to prepare an amortization schedule starting with these two numbers and reflecting a payment of $5,209, I think it was, in each case. And you'll notice that they both land where they need to, but the beginning amount is different. And the reason is it's as though the lessee did not purchase the whole asset schedule, and there's no longer what I call symmetry. Please put this video on pause and fill out the two tables, and let's see how you do. So here we are looking at our two amortization schedules. Notice that our first amortization schedule, that for the lessee, began with $14,249, and it amortized doing normal amortization techniques down to zero. But since the beginning amount was less than for the lessor, the interest rates or the interest expense for each period is less, and it ends with a zero balance. Notice also that the lessor's beginning balance of this amortization schedule included the guaranteed residual amount, making it greater. So the interest expense was greater. At the end of the lease, at the end of the third year, you did need to pick up interest. There was no payment made because the asset is going to be returned. And there is a $1,000 balance in the account for the lessor at the end. The journal entries that are going to need to be made will reflect these differences. So keep in mind, the lessee started at $14,249 and the lessor started at $15,000. And let's move on to the journal entries. Let's look at the journal entries first for the lessee and then for the lessor. Remember, the lessee only purchased part of the equipment, the $14,249. They set up the lease liability for the amount they didn't pay, and they make their first payment. Their interest expense for the first year is less because the loan balance is less. They set it up as a payable and pay it the next day. Remember, it's a present value of an annuity due, and payments are made at the beginning. And then they proceed on to their depreciation calculation. The depreciation is calculated to be $14,249 divided by 3, equaling $47.50 per year with a little bit of an adjustment for rounding. So that's how we came up with that amount, and it reflects that you're starting with the value of the equipment. Since the residual value is not guaranteed, it is not included in the value of equipment. It is left off. Now let's look at the accounting for the lessor. The accounting for the lessor ties to the lessor's amortization schedule. In a direct financing lease, they make their first payment. The difference is set up in a lease receivable, and the inventory that was purchased specifically for them is removed from the books. Now let's look at the sales type lease. This one's just a tiny bit more complicated. Let's follow it through. If it's a sales type lease on the lessor's behalf, they need to pick up, first of all, the sell. The sell is going to be for $15,000 minus the present value of the minimum, or minus the present value of the unguaranteed residual value. We've subtracted it out because it's as though we didn't sell them that amount. We pick up the lease receivable, and we pick up the cash on the first day. So we need to do something to make up for that $751. We have to take the whole $12,000 out of inventory because that amount of inventory is gone. But remember, we didn't sell $751 of it. So we also back that amount out of the cost of goods sold. So in this way, we accommodate the fact that we did not sell the present value of that $1,000 unguaranteed residual value. It reduces both the sell and the cost of goods sold amount. Now, up to this point, there's been symmetry between the lessee. Wow, there's been symmetry between the lessee and the lessor in accounting meaning that they use the same receivables and payables. This ends when you have an unguaranteed residual value, but is in place at all other times. So that can help you remember this is the one that's kind of the odd man out. And notice too that we always use the same technique to leave an ending balance on the amortization schedule when we need one. We back out the present value of whatever amount we need and calculate payments excluding that amount. That amount then grows as it runs through the amortization schedule period to be the full amount needed by the end of the amortization period. I think you can see both of these points clearly when you look at the amortization schedule. Remember, we backed out the present value of the unguaranteed residual value to come up with the payment amount, and the payment will have to be the same because one person is paying it and another person's receiving it. But with the lessee, we start with an amount that does not include the unguaranteed residual value because they don't have to pay it at the end, and it amortizes down to zero. And with the lessor, we do start with the full amount, take out a smaller payment, and we end with $1,000 in the amortization schedule at the end of the period. This causes different amounts of interest expense to be incurred on the two leases and an ending balance to be left on the lessor's schedule. It also affected, dropping down, how we calculated journal entries for a sales type lease, and this is often tricky for a student. But it shouldn't be. You need to record the sale at a lesser amount because you didn't sell the unguaranteed portion, and you drop cost of goods sold by that same amount, and the entry will still balance. This concludes my discussion on unguaranteed residual values. Thanks for joining me.